I know that a lot of you, when you're faced with investing in mutual fund schemes, face a bit of a conundrum because there are so many of them. We're going to go back to the basics in this next chat. Joining me now to talk about all of the mutual fund schemes out there is Amol Joshi, the founder of PlanRupee Investment Advisors. Thank you so much, Amol, for taking the time. I want to start by asking a very basic question. Could you help us understand, where do you start when you're trying to understand which types of mutual fund schemes are there?
Alex, thank you. As always, thanks for having me over on the show. Coming to the topic, well, I would say that you are absolutely right. As you mentioned in your opening statement, there are so many of them. We are talking about, of course, mutual fund schemes. So SEBI, the stock market regulator, has made our job easy. Sometime in 2017, SEBI came out with categorization broadly 5 categories of mutual funds, and within those 5 categories, there are roughly 3 dozen. Yes, you heard that right. There are around 36 types of mutual funds within those 5 categories. So those 5 categories are equity funds, number 1. Number 2 is debt mutual funds or fixed income funds. Number 3 is hybrid funds, where you have a mix of debt and equity. Number 4 is solution-oriented schemes. As the name suggests, those are typically towards a particular solution like a retirement scheme or a child-related corpus creation scheme, more popularly known as children gift scheme. And the 5th category is special types of schemes. Those are typically index funds, ETFs, and fund of funds that invest in overseas or domestic mutual funds. So these are the 5 categories, Alex, and I would like to say that, I would not say it's very complicated, but you'll certainly have to put your mind to it if you have to select those schemes, whether a debt scheme is right for you or equity scheme is right for you or hybrid. That largely depends on what is your financial goal, how long are you planning to invest that money for, what's your risk appetite, so on and so forth.
Okay, I think you've summed it up very well, but let's delve a little deeper, Amol. And I'm
Sure.
Primarily intending to talk about the first 3, which is equity schemes, debt schemes, and hybrid schemes. Broadly, if you were to talk about equity schemes, what would be the purpose of these, and how do you explain the different types of equity schemes?
Right, Alex, I think that's a very important question. Equity, as we all know, and there has been enough and more investor awareness programs, as well as a lot of market participants have always mentioned that equity is a long-term asset class. So you would hardly see anybody advocating equity for, let's say, a 2 weeks period or a 6 months period. Typically, when you have a goal that is several years away, and in some cases, something like a retirement, that for a 40-year-old person, retirement is like 15 to 20 years away. For a 30-year-old, it's 3 decades away. So you have a financial goal that you want to achieve, which is several years, 5 to 10 years or longer. During such, to plan for such financial goal, you invest into equity. Now, what is the reason for that? We all know that equity over a medium to long term or on a longer time frame, equity has beaten probably all other asset classes, including the debt, including gold, including even the real estate, if we were to calculate the CAGR on a rolling returns basis. Why you invest into equity is you want to participate into the growth of country or economy or companies. These are the subsets of each other. As we have seen various stories of stocks that have given 10 times, 20 times, 50 times, 100 times return. And during your long-term goal, a compounding of a 5%, let's say, that takes place in a fixed deposit at current rates, or compounding that 8 or 10 or 12% equity oriented product that will give you, that makes a substantial difference. That's number 1. Who would want to invest into equity? If you are planning for your long-term goals, that's when you invest into equities. You also mentioned, let's focus on 3 categories. So other 2 categories are debt fund. Now within debt fund also you have various other schemes or various funds, like overnight fund or a floating rate fund or a 10-year GSEC fund, etc., etc. So debt is typically, these are, of course, I must mention here that debt is not strictly comparable to fixed deposits as such, because fixed deposits from most of the times you do have a kind of a guarantee, including up to 5 lakh rupees of deposit insurance as well for your fixed deposits. Mutual funds do not assure any return, but suffice to say that debt mutual fund schemes typically invest into bonds, typically invest into government bonds or a private corporate bonds or a treasury bills, etc., etc. These are obviously, as we all know, much less volatile than equity. So you want to meet a short-term financial goal. So I would say, let's say you have to pay your child's tuition fee 3 months later. Then I would suggest you park that money into a liquid fund or a ultra short-term scheme. So liquid funds or debt funds in general, you would invest to meet your two goals. One is obviously shorter term goals, and second one is asset allocation goals as well. You and me have done various programs on asset allocation. Irrespective of how long your investment horizon is, or irrespective of whatever your risk appetite is, again, no advisor or planner ever suggests to put all 100% assets into any one asset class or category. So that also serves as an important diversification asset class. And the third one is hybrid, where, as the name suggests, you typically have a combination of debt fund, debt asset class, as well as equity asset class. Most common hybrid fund that earlier was known used to get called as balance fund, where you typically had a 65% equity and 35% debt. After the scheme recategorization, I would say a balance scheme currently has about aggressive equity hybrid scheme currently has about 60-65% of equity, 30-35% of debt. But again, I do remember we have spoken or done several episodes on one of the more popular hybrid scheme called as balanced advantage fund or dynamic asset allocation fund. Again, as the name suggests, here you have debt as well as equity, both the asset classes. You do get some stability of debt. Again, let me mention over here that the stability does not mean that you are completely insulated from any market fall. Equity component, if it is there in any scheme, you will face the equity related volatility. However, dynamic asset allocation schemes serve a completely different purpose, where the asset allocation, depending on various market levels or market valuation parameters, is completely outsourced to a fund manager, and fund manager does it on certain defined algorithm, certain defined range or formula, so to speak. So these are broadly the three asset categories. Equity you'll use for really long-term goals, hybrid funds you'll use for medium-term sort of goals, and debt funds you'll typically use for as an asset allocation asset class, as well as for to meet your short-term financial goals.
Fantastic. Now you've already explained the primary types of hybrid. There are a few more, but the ones that you've described, I think, are the predominant ones that are in use. So let's focus on equity and debt now. In equity, they're largely categorized based on market capitalization, right? And therefore have an aspect of different types of risk involved. How do you decide which one is for you?
All right. So as you rightly said, market capitalization based scheme categories are large cap funds. So the based on market capitalization, first stock to 100 stock is called as is categorized as a large cap stock. 101st to 250th. So next 150 are called as mid cap, and 250 onwards up to 500. Last 250 stocks are called as small caps. Now, as we all know, small caps typically exhibit a volatile nature in terms of both during the upside as well as downside. Now, let me take you back, not too far back into the future, but just 2018, when long-term capital gain tax, which was earlier 0%, a 10% tax was introduced. From that moment till the COVID crash, large caps were stagnant, or in fact, in those period of 2 years period, large caps actually went up to the extent of 10 to 15%, depending on which stock we are talking about. However, mid caps and small caps corrected during those 2 years to the extent of 30 to 50%. So mid cap and small cap schemes, or mid cap and small cap stocks, typically are more volatile. And large cap, obviously, you expect certain kind of stability. Large caps have a pricing power, brand power, distribution network, depending on which business are they operating into. So on the risk grade, large cap typically are considered as lowest risk within equity. Equity risk remains even in large caps, but within that equity category, large caps are considered as less risky, then mid cap, then small cap, and then there are other categories like thematic funds, a pure banking sector oriented fund, or a pure infrastructure oriented funds. Those are typically at the highest grade of risk.
Okay. There is also a broader classification. If you were to talk about the type of strategy that is being employed, there is a passive strategy that has now become quite popular for the core of your portfolio, and there is the active strategy, which a lot of people say that should be your satellite allocation or the kicker in your portfolio. Is that how you would describe it?
See, the evidence is mixed. There are certain studies. In fact, one of the mutual fund studies that came out around 3 months back, it says that largely mid-cap and small-cap funds have still outperformed their benchmark on a 5-year, 7-year, 10-year basis. So without going into, let's talk about, see this again, as I mentioned earlier, which fund category as well as which type of fund, active or passive, will depend on various parameters. So let's talk about what are the advantages, especially because we have spoken a little bit about actively managed funds earlier as well as in this episode. But what are advantages of passively managed funds? Passively managed funds remove one type of risk from your portfolio, and that risk is fund manager risk. In the sense, any fund manager, typically nobody can, no batsman scores 100 or a century in every match. Similarly, every single fund manager cannot have, the purple patch, best performance patch year on year. That is one risk that passive funds takes completely out of your portfolio, because passive fund invests, if a large cap fund, Nifty 50 fund, it typically invests in top 50 Nifty stocks, the way index is constructed, and exactly in the same weight or same proportion as that of the index.
Summed it all up very beautifully in terms of what the different products are meant to do, and you've broken it up also based on debt, equity and hybrid, and I hope that our viewers will benefit from this classification that we've talked about today. Thank you so much for taking the time.
Always a pleasure. Thanks for having me.